Good evening to you. My name is Calvawell Bower. I'll be the one conducting this online tutorial for FM303. Just to get a quick heads up, can you hear me wherever you are? If you could just kindly make an indication if you can hear me. Andre is typing yes. Nicholas, Tony, Ruben. Great stuff. So without wasting your time, guys, we need to get straight to it. So I'm going to give you guys time. If ever there's a question you have at any point in time, just make an indication so I know, and then we'll be in a position to help you out and engage with you as this session moves. Great stuff. So FM303, I'm not sure if all of you have managed to join us during our first online tutorial for the semester, the one we were preparing you guys for the assignment. And this one is specifically for modules that were not looked at. Remember, your assignment was Unit 1, 2, and 3. So we're going to concentrate on Unit 4 and also Unit 5. So I've got a few pointers there that I would actually want you guys to keep in mind as you start to prepare yourself for the final exam. So the first one I have, you should ensure that you have covered all the learning outcomes as per your learner guide. And then use practical questions from past examination papers. We have got 3 past examination papers on your e-learn together with their guidelines as well. So during this period now, when you're left only with 3 to 4 weeks before you write, it could even be less. Try to use past examination papers because they talk directly to what your outcomes also have. But you can always read widely as well, going through all the outcomes of your module. Revision study groups are always advised students, especially at this stage. And my assumption is most of you are working or engaged elsewhere. So revision study groups could actually be handy for you guys. The issue is you just need to know who stays where, and then you'll be in a position to hook up and do some few revisions together. You should also just quickly revise your assignment. On question 2, if I remember well, it had 65 marks. What that means is they've extensively examined you on FM3 on question 2 or unit 2. So as you revise your assignment, try to pick the comments that you were making and also the flow of your assignment. You might end up getting few questions that they might choose to repeat in the final exam, and I can imagine how one would regret a question that was in the assignment, and it also come back in the exam as well. It's rare, but the content itself and the outcomes are exactly the same. So it goes without saying in the exam, when you're looking at Unit 1, 2, and 3, like, it's possible that they might pick few questions, or the context of the questions could be somewhat the same, except for question 2. That was way too broad. Use of financial calculator. You guys are doing FM303. The assumption is you've passed FM2 and you know the concept of time value of money and how to use the financial calculator. And the prescribed calculator for this module, it is your HP10B2+. And whenever you're doing any calculations using the financial calculator, you should make an indication on the inputs that you're punching on your calculator. That will be a part of your working, which will then give you some marks whenever the examiner is going through your work. And then pay attention to the tutorial letter. The main thing here is cover all the learning outcomes just to be safe. And then maybe when you're only left with a week to write, then pay attention to the tutorial letter. That will be helpful than to start with the tutorial letter from the onset. I've seen few questions that were not covered in the tutorial letter, but they were learning outcomes of the modules themselves, and it's possible that that could actually happen. So let's cover all learning outcomes, and then only when you're about to, maybe you left with a week or so before the exam, you can then concentrate using the tutorial letter indications and specifications. So basically these are my few pointers that I've prepared, try to help you guys to get yourselves ready for the exam. Now moving into the actual content of Unit 4 and Unit 5, as I've mentioned earlier. Unit 4 is the product and customer profitability. Product and customer profitability. Just for me to make a quick overview of this, and then I'll get into the main outcomes. Product and customer profitability, it helps companies to allocate scarce resources effectively and also efficiently. Very rare. Personally, I haven't seen a company that has got unlimited resources, especially a company that is profit motivated, that has got unlimited resources. So money is always a scarce resource, and then we always need to make a decision on how to use or utilize such funds or resources effectively and efficiently as well. Hence, the Unit 4, which talks around the product and customer profitability. Product that we won't be making profits, one need to make a decision, or either to hold for a short period with the hope of it attaining the outcomes, or attaining the outcomes from such a project, or if that doesn't happen, it could be a good time for one to disband or to completely discontinue a specific product. The same goes for customer profitability. I always talk around how big clients, the so-called big clients, because of volume, some of them as a company you won't be making much profit out of them, but for some reason every time they make a call or they are around, they will be telling us all over and will be running like handless chicken. If you want to get to the bottom of it, usually they are the ones who ask for a discount. A discount in finance it's an expense. It reduces the total or the expected profit one would have made from a project or from a product. So that's the essence of Unit 4, product and customer profitability, how a company can utilize and allocate its resources effectively and efficiently as well. So looking at the 4 main outcomes that I just mentioned, which are important here, the first one is one need to conduct a product profitability analysis using the direct product profitability, which we are going to go through shortly. After you've conducted direct product profitability, you then use the BCG metrics to help you out to allocate first the products, and then also to help you out to make decisions pertaining strategies to use after the allocation. And then you also have got customer profitability analysis. The concept of product profitability and customer profitability is almost exactly the same. The only difference there is when you're doing a product profitability analysis, you're looking at a physical product, and then when you're doing a customer profitability analysis, you'll be selling a service. And then after you've calculated or conducted the customer profitability analysis, you then use the 4-box model and also customer segments to help you out to do the interpretation and also to pick up strategies moving into the future. So basically these are the 4 main unit outcomes of Unit 4. I decided to use a past examination paper of 2016 May to conduct a customer profitability analysis. So I'll quickly read, and then I would want you guys to have your calculators with you so that you can go through this question together. So FX is an international asset manager. Asset managers invest money on behalf of clients in order to generate a risk-adjusted return. Maybe before I proceed to the next paragraph, whenever you see case study in finance, you need to understand what is it that is going on. It helps you out on your interpretations, because at this level, FM3, it wants people to interpret things on a strategic level. So if you understand the case study itself, some of the theory questions you'll be in a position to respond, because they are more in your marketing field than the pure finance itself. So I'll quickly read again. It says FX is an international asset manager, and what asset managers do, they invest money on behalf of clients in order to generate a risk-adjusted return. FX generates its revenue income by charging 0.05% on fund size at the end of a financial year. FX has two main customer segments: the low net worth customers and high net worth customers. The information for two customer segments and for the whole company for the previous period is given as follows. So they gave us 4 columns. The first column giving you a detail of that line. The second one is the type of customer, which is type 1, which are your low net worth customers. And then we also have got high net worth customers, and the very last column is the total for the company. So the first line item we have got the average revenue attributable to each type of customer. So in short, we are generating a revenue of 1.5 million from low net worth customers and also 15 million from high net worth customers. These are revenue already in rand terms. And then I'll move on to the number of. Just a quick hint. Try to move around. Maybe you'll be in a position to get a better reception of your Wi-Fi or your network wherever you are. In case it continues to be freezing, you can always do a catch-up on the podcast after. Okay, I'll quickly then move back to the question itself. So the hint I wanted to talk around is the number of customer. If you look at, they end up putting a colon there, and then they say customer meetings, 2,000 for low net worth customers and 50 for high net worth customers. Those items are not in rand terms. And then even if you end up going to add the total of that column, of that row, is 2,000 customer meetings that you have held and servicing low net worth customers, and also 50 customer meetings we held with high net worth customers. If you are in the exam and you add the 2,000 plus 50 and it doesn't give you the total for company as 2,050, what that means is the examiner just wants you to analyze the two given, but the company could still also be servicing another client. Like in this case, they could be servicing maybe a middle net worth customer. But in this case, if I say 2,000 for low net worth customers plus the 50 of high net worth customers is going to give me 2,050. So the conclusion there is this company is only servicing 2 clients. Okay, and then I also go ahead and interpret the question itself. It says customer communications that were scheduled. We had 3,000 customer communications scheduled with low net worth customers, and we had 100 for high net worth customers. The total of customer communication that was scheduled, it will be 3,000 plus the 100, that will give you 3.1. Customer communication unscheduled, 500 for low net worth customers, and also 20 for high net worth customers. 500 plus 20 will give you 520. And then the customer information evenings, more like your investment workshops. They held 12 servicing low net worth customers and also 12 for high net worth customers. And the total of 12 plus 12, that will give you 24. So those items, if you look at them, these are what we call indirect cost. Why? They didn't give us the actual cost we incurred in servicing high net worth customers or low net worth customers pertaining these line items. So the minute you see these not being indicated in rand terms, it means they are your indirect cost. Because they are your indirect cost, you're going to use the activity-based costing, which is ABC, to allocate these indirect costs to specific customers. Like in this case, we've got low net worth customers and high net worth customers. Then they went on to give us the total activity cost, meaning the total activity we're referring to the entire company cost we incurred in servicing these clients. So the first one, we've got meetings. It costed us as a company, the entire company, 358,750 to host meetings or to conduct meetings for the entire company. And then communication that was scheduled, it costed us 310,000. Communication unscheduled, 104,000 runs, and also information evenings costed the company 1,860,000. So what this means is they gave you the total cost incurred per a specific activity. So for us to be in a position to get the actual cost for servicing low net worth customers and also high net worth customers, we then use the activity-based costing to do the allocation. We'll get to that shortly. I just wanted to interpret the question there. Additional information: FX has 1,500 low net worth customers and 50 high net worth customers. A low net worth customer has got a net worth between 1 million and 10 million. So a customer that is being referred to as a low net worth customer has got a net worth between 1 million and 10 million. And then a high net worth customer has got a net worth of 11 million upwards. And then I'll move on now to the required part. Question 4.5, it says, prepare a customer profitability analysis for each of the two customer segments. And they've given us a suggested layout is provided below. Let's say in the exam, for some reason, they choose not to give you a suggested layout. You should keep in mind, for you to be in a position to maximize or on the marks allocated on the question, try to follow exactly the layout we're using on this question. So I've got 3 columns there. The first one being the activity itself. You're going to show the working, and you get yourself a cost driver rate. So a cost driver rate, it is this specific variable that will make my cost on an activity to go up or to go down, or rather to change. So if I'm looking at meetings, my cost driver rate, the interpretation of a cost driver rate is how much is it costing us to hold one meeting. If I'm looking at communication schedule, my cost driver rate is per each communication that was scheduled, how much is the company incurring towards that. That's what we refer to as your cost driver rates. So they gave us those. So I want us to use the very question. Let me look for my hard copy so that we'll be in a position to go through this together. In May 2016, there you go. And I've got the format of the suggested layout on the screen, so I'm looking at my question paper instead. So when you're looking at meetings, and I want us to move together, guys. When you're looking at meetings, it costed us a total of 358,750 to hold meetings for the entire company effort. So when you are conducting the activity-based costing method, you then, under your workings, you actually going, let me type this under the working, and then we then go to the cost driver. I'll do for meetings, and then I'll end up putting the solutions for the other 3 activities. So under the working column for meetings, I would say we incurred a total of 358,750 rands. So that's the total cost for the entire company. I'll then go and divide by the number of meetings we held for the entire company. So if you flip back to the previous page, you realize for low net worth customers, we had 2,000 meetings, and then for high net worth customers, we had 50. The total there was 2,050, so I'll then go and say divided by 2,050. That is what I'll have under my working. And then the quotient, remember I'm dividing here, the solution or the quotient I'm going to get from this division is going to be my cost driver rate. So if we could move together and say 358, 750. We are going to do the May 2016 because of the time, and of importance there, guys, it is the concepts. The concepts are exactly the same. The only thing that is going to change, it is the scenario given. Instead of them giving you company FX, then they'll give you company Calverwell. Instead of them giving us a customer profitability analysis, they can then go ahead and also do the product profitability analysis. The concept, the one we're actually working out now of calculating or conducting allocation of indirect costs using the ABC method, the activity-based method, is basically exactly the same. So what I'm trying to do is I picked a specific question so as to talk around the concepts. The scenario, they can only change names and numbers and the actual wording itself, but there won't be any difference anyway. I hope I've responded to you fine. So get the concept right, and then you always use the very concept on a given case scenario that you are going to get in the exam. Okay, so we're going to say how much did it cost us in total? 358,750 rands divided by the total number of meetings we had. So it will be 2,050. You're going to get yourself under the cost driver rate, set 175 rands. So basically that's what one will need to do on the working part. If I then move on to communications that are scheduled, we had 3,000 communications scheduled that we had with low net worth customers, and also 100 that we had with high net worth customers. 3,000 plus the 100 gave up 3,100 and scheduled communications with customers. So all you do is just to go to the cost itself first. So the entire company incurred 310,000 divided by the number of communications we had that were scheduled, which are 3,100. You're going to get yourself a cost driver of 310 divided by 3,100. You're going to get yourself a cost driver rate of 100 rand. You do exactly the same for communications that were unscheduled. It costed the entire company 104,000 handling communications that were unscheduled, and the total number of communications that were unscheduled were 500 for net worth customers, the low ones, and also 20 for high net worth customers. That will give you 520. You're going to get yourself 104,123 divided by 520, 200 rands. So in short, the 200 rands on communication unscheduled, the 200 mean we are incurring 200 rands in handling customer communication that are unscheduled. And then finally we look at customer information evenings. The entire company incurred 1,860,000 divided by the total number of customer information evenings we held, which are 24. That is going to give you 1,860, 123 divided by 24. It's going to give you 77,500. So we have shown our working. We also worked out our cost driver rates. On the cost driver rates, in the exam, on the front page of the exam where you've got your instructions, try to pick up if they're going to mention round figures to the nearest round. If ever they choose not to give you any information pertaining rounding figures off, especially on the cost driver rate, we are talking of money here. You round your figures to 2 decimal places. That will be the cents. Just to get a quick heads up, guys, are you moving with me? Are we okay on the working portion together with the cost driver rate? Christoph, Tony, she's following that part. And then we now want to go and do the allocation of these indirect costs to our 2 customers, and thereof we then calculate the net profit that each customer is making for us as company FX. Okay. Christoph, I'll then now move on to, sorry guys, I'll then move on to meetings. We want to allocate costs which are indirect costs to low net worth customers and high net worth customers. So all you then do here, it doesn't matter the scenario given, even if it's a product, you then say, how much did it cost us to hold a meeting? If I can just quickly, I think it was 175. It was 175. So all you then do is you're going to say 175 for meetings for low net worth customers. 175 times the number of meetings we held servicing low net worth customers, which were 2,000, times 2,000, it's going to give us 350,000 rands. So that will be my cost that low net worth customers would incur in handling meetings. I would do exactly the same for my high net worth customers. I would say it was costing the company 175 rand per meeting. And how many meetings do we have? With high net worth customers, 50. So you then say 50 times 175. It's going to give us 8,750. To give us 8,750, the cost we incurred in hosting or in handling meetings for high net worth customers. I'll then move on to communications that are scheduled. Communication that are scheduled, it was the 200. Let me just quickly. That was 200 and then 277 500. So that was 100. So one is going to say 100 rands that we incurred in handling communications that were unscheduled, multiplied by the number of those communications we have for low net worth customers, which are 500. You're going to get yourself 100 multiplied by 500 is going to give us 50,000. So we incurred 50,000 in handling unscheduled communications with low net worth customers, and we also do the calculation for high net worth customers. So it was 100 multiplied by 100 was to give you 100 rand Sorry guys, pardon me, I think on this 50,000 that I did, I actually jumped the scheduled ones instead. So the cost we incurred per meeting of a scheduled communication is 100 Rand. And then I'll say 100 Rand multiplied by, let me quickly write this down, 100 Rand multiplied by the number of scheduled communications we had with low net worth customers, which are 3,000. That is going to give us 300,000. And then I will also do exactly the same for my high net worth customers, costing us 100 Rand to handle a communication that is scheduled, and we also incurred 100 of those. So I'm saying 100 times 100, that will be 10,000. That is going to give us 10,000. And then I'll move on to the third activity here, which were customer communications unscheduled. It costed us 200 Rand per unit. So we're going to say the 200 multiplied by the number of those communications we had with low net worth customers, which are 500. So 200 multiplied by 500. It's going to give you 100,000. And finally, you also move on to my high net worth customers for that. I'm saying 200 Rand per unscheduled communication multiplied by the number we had with high net worth customers. That is going to give you 200 times 20, 4,000. And then finally, we'll move on to the very last activity there, which is customer information evenings. Customer information evenings, it was 77,500 per customer information evening we had. 77,500 multiplied by the number we had, it was 12. So if I say 77,500 multiplied by 12, I'm going to get myself 930,000. This will be exactly the same for your high net worth customers because we also had 12 with them. So we have now allocated indirect cost to our customers in this regard. It was our low net worth customers and also our high net worth customers. Our low net worth customers and our high net worth customers. From here on now, we need to go and calculate our total cost. So using the figures that we're populating here, guys, can you kindly type for me the total cost for low net worth customers and also the total cost for high net worth customers? You can use the abbreviation for low net worth customers being LNW and high net worth customers being HNW. Just for me to see if you're following before we actually calculate the profit itself. Tulish is right. If you calculate the one for low net worth customers, it's going to give you 1,680,000, and then we also need to do the one for high net worth customers, which is 952,750. That is right. So what then you do, you are having these two figures now. My total cost, and remember, since these are costs, you put those in brackets to indicate these are cost. So you've got 1,680,000 in brackets as your total cost for low net worth customers, and also for high net worth customers you're having 952,750 in brackets. If you then, since we are following through or using the format that is given here, I'll then now bring in the revenue attributable to each customer. the revenue is given on the question apparently. It says low net worth customers, the average revenue attributable to each type of customer. In this regard, for low net worth customers, it was 1.5 million, and also for high net worth customers, it was 15 million. Sorry. So I'm going to have my total cost on top, and then the revenue attributable to each customer, 1.5 million for low net worth customers, and also 952,750 for high net worth customers. The difference of the two, usually the flow is your revenue is always on top, and then your total cost will come immediately beneath that. But since you wanted to follow the format that was suggested, I'm still going to have revenue subtract my total cost. So I'm saying 1.5 million being positive on revenue minus the cost of 1,680,000. You're going to get yourself a negative of 180,000 for low net worth customers. So you put that in brackets, and then you do exactly the same for high net worth customers. The revenue per customer who is a high net worth customer is 15 million minus the cost 952,750. That is going to give you 14 million. Apparently this one is positive. 14,047,250,000. So I've got 180,000, which is a loss on low net worth customers, and we also have 14 million and 47,250,000 rands for high net worth customers. So we made a profit on high net worth customers, and we also made a loss on low net worth customers. Just before we go to the interpretation, did I lose someone, guys, on how we showed the working, the cost driver rate, how to then allocate the cost to these two customers using the activity-based costing, and also us inputting the revenue element to calculate the profit? Are we all together there? Because I looked at your tutorial later, it said you could be having 40 marks coming from learning unit 4, hence my emphasis to see if everyone is there. Great stuff. So we then now need to move on to the interpretations thereof. So on the interpretations, I'll then move on to question 4.6. It says, explain why the nature of FX business will only allow it to be profitable with high net worth customers. On this one, it's an open question which is everything to do with marketing and also with finance. I just want to pick maybe 2 points from you guys there. Why would you think the type of business FX is conducting is only going to allow them to make profits with high net worth customers and not with low net worth customers? Your thinking, and then we move on. Yes, Tony, high net worth customers are less than low net worth customers. That's very right. The reason being, your cost driver rates, which are variable cost, the variable cost per unit is exactly the same for high net worth customers and also for low net worth customers. So the lower the number of customers you're servicing on high net worth customers, and going to make sure that the cost you incur are going to be less than the ones for high net worth customers. Even if you look at the figures, we had 50 high net worth customers, and we also have got 1,500 low net worth customers. So if you look at total variable cost, the variable cost per unit is fixed, but the total variable cost itself is the one that fluctuates with volume. So I would agree with Tony that high net worth customers has got less numbers than low net worth customers, which we talk of in economics, and we refer to that as economies of scale. What other point, guys, would you raise there? There was someone who was typing. Is there other point that you might also want to raise there? Yes, Adre. She's typing. Let's quickly wait up for a response there. We discussed that we'll be in a position to move on. Apparently, it looks as if she's also going offline. Okay, we're going to talk around a comment once it had dropped. So basically, okay, hello, I think because the high customers are few and not price sensitive. That's a very good point on the issue of price sensitive. Look at the number of unscheduled meetings that we had with low net worth customers. There were 500, whereas for high net worth customers there were only 20. If you look, the range or the net worth these high net worth customers have of more than 11 million, they don't want to have their portfolio being rebalanced time and again, because chances are they will be making some steady income elsewhere, and whatever that they've already invested with you is something that they're not going to use it anytime soon. So that would be another reason as well. Thanks so much, Adrian. And then I'll move on to question 4.7. It says, discuss why FX may still have an individual customer segment in its business. Discuss why FX may still have an individual customer segment in its business. I'm quickly going to make you guys make a reference in your learner guide to the 4-box model. So critical when you're doing this interpretation. And I'm going to quickly tell you on what page we've got our 4-box model. And then I want us to, using the net profits or the net losses we calculated, to go and identify where low net worth customers will fall under and also where high net worth customers will fall under. So if you go to page 191 in your learner guide, we have what we call the 4-box model analysis. On your x-axis, you have profitability and also loss making. And then on your y-axis, the upper part is your target. And then the lower part, it will be your non-target. So looking at the calculation we did on question 4.5, where would you position low net worth customers on this 4-box model, and why would you position them on that category? Maybe 1 point from you guys, and then we'll be in a position to move on. I'm trying to engage, especially on this unit, because it might come with 40 marks in the exam. You need to know what's going on there. Remember, our low net worth customers, we made a loss of 180,000. On high net worth customers, we made a profit of 14,047,250. So I'm trying to engage using those two figures. How would you then go and allocate low net worth customers, and why would you allocate it in such a specific segment? Charity is typing, you hear what she says, and then I'll be in a position to tell you what's going on, and then we move. I'm not sure if it's also network with Charity. Oh, there she goes. Charity says, I think we should replace. Okay. Drain is also typing. You know, on the replace part, you wouldn't say we should replace. The reason being, a customer that falls under replace, it is a customer which we are not targeting. But if you look at the context of this question, if I read the very first sentence, it says, FX is an international asset manager. Asset managers invest money on behalf of clients in order to generate a risk-adjusted return. FX generates revenue income by charging 0.05% on fund size at the end of the financial year. FX has got two main customer segments. So I wouldn't mention replace, because if they're having two main customer segments, it goes without saying they're actually targeting low net worth customers as well. That's right, Adrian. Your low net worth customers are going to form low net worth customers are going to fall on your transform. The reason being, we are targeting them, but we are making losses from them. So since we are targeting them and we are also making losses, the strategy there, the first thing is they're going to fall under the transform, and then secondly, the strategy is to try to transform them urgently, to move them, or in actual fact, the first thing is go and find out why are we making losses with them. So you're trying to get a solution from their point of view, because they're offering a service. Yes, it's financial, but there's also a lot to do with the service itself. So the first thing, go find out what is it that we are not doing right, or what is it that they're expecting in that bracket of being called low net worth customers, and then try to rectify that. But this needs to be done urgently, because they're falling through our target market, but they're loss making. So if you transform them and you do everything right, you should be in a position to transform them to move on to the retain. If you don't do anything around that, you have made a loss of 180,000 whilst you're making an average revenue of 1.5 million per customer, falling under low net worth customers. That might not look that bad, but then if you don't then do address issues that could be arising from engaging them, you actually could be setting yourself up for huge losses moving into the future. So your low net worth customers are going to fall under transform. Urgently give them attention, find out why is it we're making losses, and then you'll be in a position to transform them from profit making to the retain itself. And then finally, the easier one is, where would one allocate the high net worth customers? We are making huge profits, 14 million 47,250 rands from high net worth customers. It goes without saying we're going to have these guys under which category. Adrian is typing, and then we'll be in a position to wrap this question up now. Okay, that's right. We're going to have your high net worth customers falling under retain. That's right, Charity and Adrian. The reason being that, one, they are falling in our target market. Two, we are being profitable by servicing them. So they are under our retain. So what is the strategy on retain? From the very term itself, retain, it means you need to retain these clients by, the first thing, you need to continuously build more closer relationships with them, so that they'll be in a position to be loyal to you, and then they will stick with you. If you don't try to continuously build the relationships, they might end up trying next door. As much as they're profitable, they could be lured by other competitors in the market. So try to have a good or a strong relationship with them moving forward, so that you'll be in a position to retain them. So that's basically why FX still needed to have customer segments. And then maybe one point I'll make before we then move on to the other unit 5. If you look at the type of business this company is conducting, it's giving advices to clients so as to invest in portfolios that are going to give them a better return and also assuming low risk. The range of low net worth customers is 1 million to 10 million, whereas high net worth customers are 11 million upwards. As much as the low net worth customers were unprofitable, in actual fact we made losses out of them, you still need to tailor-make relationships that you'll be having with low net worth customers, because you could be sitting with someone who is sitting at 9 million. It's very, very possible to say in the short term they'll be having more than 11 million, and they'll also need to be transferred to fall under the high net worth customers. If you then don't continuously monitor what's going on with them, you might continuously leave them in the low net worth customers, and people of that nature will be having a lot of money. They've got ego issues, and if you don't massage such ego issues, you might end up losing those customers. So you also needed to continuously monitor those clients that are falling between 1 to 10 million on low net worth customers, so that you'll be in a position to elevate others into the high net worth customers. So basically that will be your comments on a customer profitability question. Look at the 4-box analysis together with the strategies as well. So that's basically what customer profitability analysis is. Let's say the exam that you guys are going to write in a month's time, then the question is not a customer profitability, but rather a product profitability. The concept is exactly the same. How you're going to allocate indirect cost using ABC will be exactly the same. The only difference is when you're working out a question with with product profitability analysis, you don't use the 4-box analysis, but rather you use the BCG. And the BCG, remember, that's where we also have got 4 boxes there. The first one being your question mark, we've got your dog, you've got your cash cow, together with your stars. The main difference I would just want to mention in the BCG matrix, it's between the cash cow and the star. They've already captured market share, both of them, but a star falls in a market where it has got potential to grow more into the future. Whereas a cash cow, the growth rate itself has slowed down. Since it has slowed down, you might just want to milk, or in short, you're trying to get as much cash or profits as you can whilst you're maintaining the product. And I often give an example of Coca-Cola there. Yes, we understand now we've got Coke Zero, your Coke Light, and so forth. But for some reason, people are becoming more healthy conscious now. And are people still consuming Coca-Cola? Yes, of course. They are still making profits? Yes, of course. But then when it comes to investment in the product itself, they're not extensively investing in the product because it still is falling under the cash cow. All they are doing there is to make money whilst they still can, and you never know if this product will ever come out of the market in the near future. I don't see it happening. So basically that will be your comments. If you have your product profitability analysis, use BCG metrics for interpretation and also for allocation, and then finally for strategies. Whereas if it's a customer profitability analysis, you use your 4-box model. I've spent almost an hour talking around this. I'm trying to give it attention because of what the tutorial letter made an indication on. So don't only concentrate on the calculation part, but also on the interpretation, the strategies using these 2 methods, the BCG, if it's product, and also the 4-box model, if it is a customer. Are there any questions, guys, on Unit 4, on what we've discussed and the hints I've been trying to give you before we move on to learning Unit 5? Any questions there that I can address? Then we'll be in a position to move on to learn Unit 5. Gustav, you're welcome, Tony. I'll then move on to learn Unit 5. It is product. I think I've made a mistake there, guys, pardon me. Learn Unit 5. We're looking at, let me just actually read out the exact name of the topic itself. It is titled Quantifying Proposed Marketing Strategies and Projects. Quantifying proposed marketing strategies and projects. The main outcomes from this unit, the first one is you should be in a position to describe the meaning of cost versus benefit analysis, which is CBA. Let me just say something on CBA, on the definition part. The reasoning here is you wouldn't want to implement a project that is going to give you benefits that are less than the cost you incurred. So on average, when you're conducting a cost-benefit analysis, you would want the benefits to be more than the cost, so that you'll be able to make that project viable. If it's not viable, surely there won't be any reason for one to even contemplate implementing such a project. So that's basically cost-benefit analysis. And then evaluate the cost and benefit alternatives. So when you're doing the evaluations, you need to either pay attention to the unit of measurement. If I can give an example of the FIFA World Cup that South Africa hosted in 2010, you could have had two variables on your unit of measurements. Maybe the first one could have been the cost itself, which is the monetary. How much is it going to cost us? And are we going to have any other benefits after the stadium has been built, also together the infrastructure that was also refurbished during the period? So when you're looking at that, you're looking at a public project, and you're looking at profits, not the immediate profits or benefits, but rather spin-off benefits as well after the project have already been completed. So that would be a unit of measurement. In another unit of measurement, one might also be looking at, it could be time itself. Let's say I've heard that Samsung have already dropped the S8 in the market. So sometimes it might not be the financial component itself which are cost and the benefits in monetary terms, but rather the timing itself. So if you were iPhone, you could have been trying to beat Samsung to drop the i8 in the market before they actually do that. So for strategic reasons, when you're looking at quantifying proposed marketing strategies and projects, not only are we going to look eventually on the financial implications, but sometimes we'll also be looking at a different unit of measurement like time. That's what I wanted to mention there. And then finally, of importance on Unit 5 is one need to know how to conduct brand valuation. One need to know how to conduct brand valuation. So with that in mind, I also used the May 2016 paper. It's not like the reason I picked the 2016 paper is because I'm thinking they're going to bring exactly the same paper because you guys are going to write the May paper. Not necessarily, but the type of the question that they gave, they can make you guys to be in a position to understand exactly what is going to be expected. I'm not hinting as such. Remember, I'm not the examiner for the module. I chose this question specifically because it helps you out to understand the topics and the outcomes, and then you'll be in a position to apply the very interpretation we're doing now and your level of understanding in any question that you see falling through this table, falling under these units. Okay, so we've got part B of May 16 exam. I'm quickly going to read. No, actually, I don't set the paper. Apparently, I'm only going to see it after you guys have already wrote. I'll move on to part B. An international jeans manufacturer, Zevis, which is Z, is looking to expand its market and product range. Like I said, guys, we are doing finance that has got an inclination to marketing. You need to understand the case study given so that you'll be in a position to respond and do the interpretation thereof. So I'm going to read so as to try to make you guys understand. An international jean manufacturer, Zevis, Z, is looking to expand its market and product range. Look at the objective. This is more marketing than anything else. They want to expand the market, they want to gain market share, and also to expand the product range. The easiest, yet the most risky way is by acquisition of a competitor. In this regard, false religion is seen as the most viable target organization, meaning FR, it is a competitor. Service wants to value false religion. The minute you see this, what should come to mind is we are going to do brand valuation. I'll read on. Service CFO tells you, we will pay what we can get out of it. That's all. We have the production. I'll read that again. We will pay what you can get out of it. That's all. We have the production and design. I just want their brand. So what Service wants to do, they want to buy FR brand. Are they going to then change the name FR? No. So they're going to continuously sell their Z products and also FR as a standalone brand, but then they'll be possessing both the two brands. Service CFO vision in this brand acquisition is to use economies of scale. Remember, these guys are already having the production and the design, so they can actually accommodate. Their capacity is huge. They will be able to accommodate the FR. I'll read that statement one more time. Service CFO vision in this acquisition is to use economies of scale in its current marketing and production facilities, but at the same time maintain brand and product differentiation. So they're not going to change the FR to become Z. The Z to stand on its own FR as much as there will be the owner in case they end up going ahead and buy this brand. Service and false religion do not sell any other product except a single cut of jeans. It's so important because your interpretation in this regard, these two companies are only selling jeans. Z sells the jean called product Z, and also false religion is selling the jean called product FR. So Service and false religion do not sell any other product except a single cut of jean. Service single cut of jean is called product Z, and false religion single cut of jean is called product FR. The following table represents the current forecasted value of Service, and of importance there is the wording here. It says the following table represents the current forecasted value of Service. Remember, the company we are looking at here, or I'll interpret this from our point of view. The company we're working for, it's called Service. We have already done a projection. So the projection that I'm going to have on the next slide, it's not actuals, but those are projections. So we've already done a projection for Service. That is before the possible acquisition of false religion. I'll read the statement one more time. The following information, the following table represents the current forecasted value of Service as of January 2016. That is before the possible acquisition of false religion. So I'll then look at the information on the table. So they gave us year 2016, year 2017, and year 2018. And then I'm going to pick year 2016 just to talk around what is it that they gave us, because we're going to use the very format to do our preparation of our response on it. Sales revenue of product Z. It says 5.4 million. How do they calculate the 5.4? I have sales price and I also got the number of pairs. So in short, the selling price for this jean called Z is 450 rands. And the number of pairs we are anticipating, remember this is a projection, we are anticipating to sell 12,000 pairs of jeans. If you say 450 rands times 12,000 pairs, it is going to give you 5,400. That's how you would have calculated your sales revenue for product Z in year 2016. I'll move. Cost of sales, it is given as 2.7 million. And then gross profit, you calculate gross profit by saying sales, like in this regard is my sales revenue of 5.4 minus my cost of sales of 2.7 million. You will get yourself a gross profit of 2.7 million. You're anticipating to incur operational cost of 500,000, advertising cost of 300,000. For you to get your profit before tax, you will then say the 2.7, which is a gross profit, minus the 500,000 of operational cost minus the 300,000 of advertising cost. That will give you the 1.9 million. So my profit before tax, 1.9 million, and then your tax rate is 28%. So if you say 28% of 1.9 million times 0.28, you get yourself 532,000. I'll have the tax in brackets. Then you say 1.9 million minus the tax of 532,000. You're going to get yourself a net profit of 1,368,000. That is exactly what is happening on year 2016, 2017, and 2018. I want to come to the last figure on that table that says the net profit including terminal value. The concept of terminal value only comes when dividends are going to grow indefinitely from the last year. So the terminal value that you're going to calculate is only going to affect the last year of our projection. And in this regard, it will be 2018. So if you look at that net profit including terminal value, your figures of net profit dropped exactly as is for year 2016, even for year 2017, but it's not the case for year 2018 because of the terminal value, which we are going to do the calculation on when we start to respond to our question. And now, if false religion is purchased by Zevis, the following changes in the above forecast of Zevis are expected. The above table we have, it's a projection for Zevis only. If we then go ahead and buy false religion, these are going to be changes to the information that we already have. Number one, no changes are expected in the current product Z sales. So Z sales are not going to change, as well as cost of sales, as competition and marketing growth or market share have already been considered in the above forecast. So my sales together the cost of sales for Z are going to remain exactly as they are. The sales revenue for product Z is expected to grow at 6% from the beginning of year 2009 into the foreseeable future. We are going to use this 6% to calculate our terminal value because it's talking around at the beginning of 2009 into the foreseeable future, meaning indefinitely. That's where the terminal value is going to be calculated. So we calculate the terminal value from the concept of dividend growth model, which is your golden growth model. I'll read the question. Note number 3, it says, based on sales forecasted data from current product FR sales, product FR is expected to sell at 500 Rand a pair. So a pair of jeans for product FR is 500 Rand. And we're anticipating to sell 10,000 pairs for the year 2016. So if I want to calculate my sales revenue for FR for 2016, I would say 500 Rand per pair times the anticipated volume, which is 10,000. We'll be selling, we're going to get an anticipated revenue of 5 million in year 2000 and in year 2016. I'll then finish off the statement. This is expected to increase by 100 pairs in 2017. What is it that they're referring to as this? It is the volume, which are the 10,000 pairs. So in 2016, you are anticipating to sell 10,000 pairs. This is expected to increase by 100 pairs in 2017 and stay at that level for 2018. What that means is your sales volume of jeans that you're anticipating to sell in 2017 are going to increase by 100. So in 2016 we would have sold 10,000. So if we're going to sell an additional 100, it goes without saying in 2017 the volume is going to be 10,100. It is going to be exactly the same for 2018. The sales revenue for FR is expected to grow at 6% for the year 2019 and is expected to be preserved at that rate for the foreseeable future. Can you see the 6% of Z in 2019 is exactly the same for FR in 2019 onwards. So that becomes the growth rate for the company as a whole moving into the future. We're going to use that percentage when you calculate terminal value. The cost of sales for product FR is currently calculated at 225, meaning in 2016. And it is expected to increase next year, meaning in 2017, by the rate of inflation of 6%. You then say times 1,06. This increase in cost is assumed to be constant for the foreseeable future, meaning the cost of sales of FR is 225 in year 2016. It will increase at 6% into year 2017. So if we say 225 times 1,06, it will be then your cost of sales in 2017 are going to be 238 rands and 50 cents. Since the statement says this increase in cost is assumed to be constant for the foreseeable future, meaning from one year to another. So when you do then the calculation of cost of sales, for 2018, it will be the 238,50 times 1,06 to give you 252,81. Of course, multiplied by the number of units that we were selling. We were selling 10,100 in 2017 and also 10,100 in 2018. And I'll then move on to operational cost. Operational costs are expected to increase by 100,000 in 2016. So if you look at the operational cost we had for service, there were 500,000. There were 500,000 in year 2016. So they're only going to increase by 100,000. Now, technically the interpretation is operational cost of 500,000 for 2016 is for Z. Remember, these guys already have the capacity in the design and the production plant to also incorporate FR. So they are only going to increase the operational cost by 100,000 in 2016. What then does that mean? It means the total that the company is going to incur towards operational costs in 2016 is going to be 600,000. 500,000 plus the additional 100,000. This is expected to grow at the rate of inflation of 6% thereafter for the foreseeable future. When they then say thereafter, it goes without saying, from year 2016 to year 2017, it is going to increase the inflation rate times 1,06. You also do the same from year 2017 to 18 times 1,06. Advertising costs are expected to double in 2016. So if you look at your equation, your 2016 advertising cost with 300,000. Doubling it means times 2. So the total the company is going to incur if they go ahead and acquire FR towards advertising cost in year 2016 will be 600,000, which is 300,000 times 2. This is expected to grow at the rate of inflation, which is 6% per annum, thereafter for the foreseeable future. Same interpretation, from year 2016 to 17 times 1,06. From year 2017 to 2018 times 1,06. We have got a once-off capital expenditure for 2 million, which is required at the beginning of 2016. Since it's required initially, it goes without saying this is going to be an initial outlay. So when I'm going to calculate NPV, I'm going to start with CF0 being negative 2 million. The business risk and financial structure of service is expected to remain constant, leaving the weighted average cost of capital or discount rate at 14%. So our weighted average cost of capital of our discount rate is going to remain at 14%. What if this statement came and say the business risk and financial structure of service has increased because of increased risk they are bringing in a new product, it's moving to 16%. In case they do that, it goes without saying your discount rate in this calculation then is going to move to 16%. But in this regard, it's going to remain exactly the same. We're going to use 14%. And then the last additional information is the corporate tax rate is 28%, unless told otherwise, and usually it's 28%. But don't make an assumption. They might choose to use 29% there in the exam. You should use the tax rate that is given. I'll then move on to the questions now. Question 5.4 says, Explain the difference between incremental approach and residual income approach in brand valuation. The difference of these two is, incremental approach, what it does, it will separate or it isolates the expected revenue from the branded product, and then you discount all expected revenue from the branded project separately. You don't combine it with the company, and then the NPV that you get, that becomes the value of your brand. Of which your residual income approach is going to use projections for total revenue for the entire company. Like for the entire company in this regard, we'll be using both projections for FR and Z. The total for the company, we do the forecast, get your future cash flows, discount them back to today by calculating NPV. And then the difference now of the NPV of Z, subtract the NPV of the total company. If we then go ahead and buy FR, the difference of those two NPVs will give you the value of the brand FR in this regard. Now, question 5.5, which I'm trying to get to now, it is saying, using the residual income approach to brand valuation, calculate the maximum amount Zevis will be willing to pay for the false religion brand. This question will always come and say, calculate the maximum amount. They don't ask you to calculate NPV. They don't ask you explicitly to do brand valuation. But in short, we are going to conduct a brand valuation exercise. So I want us to quickly go through that part of the question, and I'm sure that will be that for the evening. Let's see how long this is going to take us. So, did they give you a format on how to respond to this question? No, they didn't give you. What then do you do? You're going to use the format that you are given on the projection of Z. So I'm going to come back to the question itself, and then we're going to work out few questions and indication on what needs to be done as we move together. So when you want to now calculate sales, I'm going to have sales. I will leave two lines underneath my sales. The first line is going to be the sales revenue for Z. The second line is going to be sales revenue for FR. So your sales revenue, like when you're calculating this in year 2016, Z sales revenue is not going to change. Additional information number 1 gave us such a stipulation. Now calculating sales revenue for FR, you're going to say the selling price per gene, 1 pair of gene for FR is 500 rand. It is 500 rand. $500 times the number of units we're anticipating to sell, it was 10,000. That was going to give you 5 million. So that will be the sales revenue for year 2016 for FR. I want to bring in now the total. Remember our sales revenue for Z in year 2016, it was 5.4 million. So you then say 5.4 million plus the 5 million we are going to anticipate to get as revenue from product FR. You get your total there. That is going to be 10,400,000. That will be 10,400,000. That becomes the sales revenue for year 2016 for both the products. Now, if you move on to year 2017, you then say, I just want to mention the year 2017 will be exactly the same when you then move on to year 2018. In year 2017, of course, your sales revenue for Z will remain exactly as is, 5,490,000. But your sales revenue for FR, the selling price per unit didn't change, which is 500 rand, multiplied by but the number of units that you're selling in year 2017 have increased by 100 rand to 10,100. This is going to give you 500 times 10,100. It's going to give you 5,050,000. And then you do exactly the same for year 2018 for FR. So if I want to calculate my total revenue in 2017 for both FR and Z, I will say the sales revenue for Z is given 5,490,000 plus the sales revenue for FR we just calculated now, which is 5,050,000. That is going to give you a total of plus 5,490, 10,540,000. Are you guys with me there on the calculation of sales? You're going to go do exactly the same for year 2018. You guys following me there on the increase of number of pairs of jeans going to be sold, increasing by 100 rand. So that will be 9% to move on to the cost of sales portion. Great stuff. Great stuff, Michael. Great. So that's basically what you then do when you're calculating sales revenue for the entire company. Z was given. Then you just follow the instructions for FR. Okay, on your presentation, Adrian, on the first line, I would say sales revenue. Just underneath the sales revenue, T0021. Okay, let me say this pertaining to the presentation. You're going to follow through exactly, almost exactly what you're having on the question itself. So on my sales revenue, I'm not going to say sales revenue of product Z. I'll just say sales revenue because I'm now looking at the entire company using the residual income method. So I'll say sales revenue. Underneath where you're having sales price there, I'm now going to put product Z. Where I'm having number of pairs, I'm going to put product FR. I'll bring in figures of sales of product Z exactly as given, and then I'll also then bring in the sales figures of FR exactly as we have calculated. Year 2016, 10,000 pairs being sold at 500 rand gave us 5 million. So in year 2016 now I'll say 5 million of FR plus 5,400,000 of Z. The total, I will then put it in line with my sales revenue as 10,400,000. Did I respond to you there, Drain? And T0021, which parts are you not following there? Is it the presentation or where are we getting figures for FR? Great stuff for Drain. Let's see what TT0021 is saying, and then we'll be able to move on. Oh, great stuff. So we now proceed to move on. So that's what you do when you're calculating your sales revenue. Cost of sales. Note number 1 says cost of sales for Z was also going to remain exactly as is. So I'm going to use the very same format. My cost of sales, underneath the cost of sales, I'll put cost of sales for Z, which is what is given. And then I'll also say cost of sales for FR. My cost of sales for FR, let me talk around that. I'll go back to the question. It says, the cost of sales for product FR is currently calculated at 225 rands in 2016. So in 2016, I'm not going to do anything. I'm going to say for FR, 225 times. Remember, we're anticipating to sell 10,000 units in 2016 times 10,000. It will give you 2,250,000. So my cost of sales for FR in 2016, I would have shown the calculation by saying 225 times 10,000. That was going to give you 2,250,000. So that becomes my cost of sales for FR in 2016. Remember, cost of sales for Z in 2016 is given as 2.7. So I'll then say my 2.7 plus the one we just calculated now for FR, which is 2,250,000. That will give you the total of your cost of sales for year 2016, which is 2.7 plus 2,250,000. That is going to give you 4,950,000. So that becomes your cost of sales for year 2016, 4,950,000. I want to move to year 2017 and you then do exactly the same thing for 2018. In year 2017, if I read the statement, it says, the cost of sales for product FR is currently calculated at 225 rands in 2016, and it is expected to increase next year, meaning 2017, by the rate of inflation of 6%. This increase in cost is assumed to be constant for the foreseeable future. So when you're calculating cost of sales for FR in 2017, cost of sales for FR in 2017, you're then going to say this. You're now going to say my 225 is going to increase by 6%. So I'm going to say 225 multiplied by 1,06 multiplied by the number of units that we were selling, we're anticipating to sell in 2017, which are 10,100. This is going to give us our cost of sales for year 2017 for FR, 225 times 1,06 times 10,100. You're going to get yourself a cost of sales of 2,408,850 for FR. Are you guys following me there on the cost of sales for FR in 2017? Great stuff. You then also going to do exactly the same when you move into year 2000 and 2018. So that was the only tricky part I picked on this question, the cost of sales, because your cost of sales, they move linearly with changes in your sales revenue. So you needed to keep in mind that your number of units that you're going to sell, they're going to be 10,100 in 2017 and also 10,100 in 2018. You then now say your sales, I'm talking around the year 2016, your total sales revenue minus my cost of sales, which is also total of cost of sales. That was going to give you your gross profit. Gross profit minus your operational costs. They were going to increase by 100,000, meaning in 2016, they were going to be 600,000. 500 plus the 100 is indicated, 600,000. And then if you look at the additional information, it says, the operational costs are expected to increase by 100,000 in 2016. This is expected to grow at the rate of inflation, which is 6% per annum, thereafter for the foreseeable future. So when I'm calculating operational costs for 2017, I'm now saying 600,000 times 1,06. That should give you 636. So your operational costs in 2017 are going to be 6,036, and then when you also do the one for 2018, you're now going to say 636 times 1,06. Let me just quickly confirm that times 1,06 times 1,06. You're going to get yourself 674,160. That's basically how you then calculate your operational cost for year 2018 as well. Okay, 636 is for year 2017. Year 2016 will be, so for year 2016, your calculation would have just been, oh, great stuff. It was going to be 500,000 plus the 100,000. That was going to give you the 600. Great stuff. You then move on to advertising cost. On your advertising cost, additional information reads, advertising costs are expected to double in 2016. So my advertising cost in year 2016, I'm just going to say 300,000 times 2. That was going to give you 600,000. And then I'll read where that statement again. It says advertising costs are expected to double in 2016. This is expected to grow at the rate of inflation of 6% thereafter for the foreseeable future. Meaning the 6% is going to apply from year 2016 to 17 to 18. So when you're calculating your advertising cost for year 2017, it's going to be exactly the same as your operational cost, 600,000 times 1,06. That will give you 636. And then, of course, when you then calculate for year 2018, is also going to give you 636 times 1,06. That will give you, I've done this calculation, I think, just moved here, 636 times 1,06. It's going to give you 674,160. So it was a coincidence that your operational cost together with your advertising cost were going to be exactly the same in year 2016, 17, and 18. The reason being we doubled advertising cost from 600 to from 300 to 600. So you then subtract your operational cost from your gross profits. You get yourself your profit before tax. The tax rate is 28% as indicated on the question. You then say your profit before tax times 28%. You get the tax expense itself, which you should put in brackets. And then thereafter you then say profit before tax minus the very tax, which is at 28%. You get yourself your net profit. You do exactly the same for year 2017 and also year 2018. I want to come to the terminal value element and then the NPV calculations. When you then calculate in year 2018 the projections now, you need to calculate the terminal value. The concept of terminal value is derived from the dividend growth model, which says terminal value is equal to your D0, 1 plus G, D0, 1 plus G, close bracket. Apparently the G should be a small cap. D0 increasing at the growth rate. So you say D0, open bracket, 1 plus G, close bracket, divided by your WACC, which is your weighted average cost of capital, minus your G. So the concept of terminal value, it comes from the concept of dividend growth model. So if I then actually want to do this calculation, you then go and say, your terminal value is going to be equal to your profit figure in year 2018. Your profit figure in year 2018 growing. So you open a bracket and then say 1 plus G, close bracket, divided by your work. In this regard, your weighted average cost of capital, it was 14%. Subtract your growth rate, which is 6. So where are we getting the growth rate? It is the one that got mentioned, which is the rate at which FR will be increasing from the beginning of year 2019 onwards, which is exactly the same figure or the same rate. Z will also be increasing from year 2019 onwards. So basically that's how you then calculate your terminal value. Are you guys with me there on the terminal value calculation? You take your profit for year 2018, which is the terminal, which is the last year, multiplied by 1 plus G. Your G is growth rate. The growth rate mentioned is 6%, which FR and Z will be growing from year 2019 onwards, divided by your work, which is 14%, 0.14 minus your G, which is your growth rate of 6%, which is 0.06. That should give you your terminal value. So if you look at the question, it says the net profit including terminal value. So you would have had your net profit of year 2018 plus the terminal value itself, because the question says net profit including terminal value. You are going to get yourself your terminal value inclusive of the net profit for that very year. You guys with me there on the terminal value itself and the calculation and why we use the constant growth model. Okay, on your terminal value, calculate your terminal value standing on its own first. So this is what you do. Remember, we were talking around how to calculate net profit for year 2016 and year 2017 and 18. So let me use the example that you have on the question paper itself on page 6 of 8. On page 6 of 8, let me calculate the terminal value using that figure there. I hope they are correct on the question itself. Can you see your net profit of year 2018, which you would have calculated yourself as we were doing this? So you get yourself a net profit of 1,377,806. So you're going to say, if I'm using the question paper itself, 1,377,000, I would have said my TV is equal to 1,377,806. Growing at what rate? 1,06. 1 plus 0,06 close bracket divided by your work is 14%. I can just open a bracket and say 0,14 minus your growth rate 0,06 close bracket. So if I'm using the example that we have there, our net profit in the terminal year, which is 2018, was 1,377,806. So that is the very figure you then use from the computation we were doing to get yourself your terminal value. So if you can just punch those figures in with me, let's see what they have there. 1,377,806 times 1,06 divided by 0,14 minus 0,06. You are going to get, as indicated on the question paper itself, the terminal value. Can you see where they highlighted just underneath the table on the question itself? Let me just put the question also on my screen. Can you see your terminal value was going to be 18,255,929.50. If you round it up to the nearest rand, it was going to be 18,255,930. Are you following there, Cherit? Great stuff. So you would have got yourself your terminal value. Then you then say, what was the profit for that terminal year? 1,377,806. 77,806 plus the terminal value of calculated of 18,255,030. That was going to give you the net profit, including terminal value of that 19,633,736. After you have done that, you then come and say, maybe should I ask this question? Did any of you made a printout of the guideline for this paper year, May 2016? What is your net profit for year 2016? I want us to do the NPV calculation together there. Okay, it's not a trace match. Rather, let's Drain is typing. Let me quickly see what she has. Just the net profit including terminal value. And also 2016 and 2017. So we want to use those figures to calculate our NPV, and then the difference of the two is going to give us, so it's 2,851,775 year 2018. Okay, you can start again, Drain. So we want the net profit, including terminal value for year 2016, and also for 17, and also for 18. So we can calculate the NPV. That's right. Net profit including terminal value for year 2016, 2017, and 2018. You can just write the figures respectively. Year 2016, 3,060,000. Thank you. Waiting for year 2017. 2,962,188, and then for year 2018, it was 40,637,794. So after you have calculated your net profit after including terminal value, those were the figures. Thank you so much, Drain. So with those figures, when you want to calculate the net present value or the value of this entire company now, this is what you then do. Remember, on your additional information, I just want to quickly flip back to the additional information right at the end. It says a once-off capital expenditure of 2 million is required in the beginning of 2016. So when you're calculating your NPV, you use the CFJ method. So you're going to say your cash flow 0, negative 2 million. So when you're punching these figures in the calculator, you're going to start by saying 2 million plus minus CFJ. 2 million plus minus CFJ. So that becomes my cash flow 0. It was negative 2 million. Cash flow 1, so that was 2 million plus minus CFJ, cash flow 0. Cash flow 1, it is your net profit including terminal value. So it's the net profit including terminal value from year 2016 where we started the projection. So my cash flow 1, in your calculator you're going to say 3,060,000. 3060, 123, CF1 to say cash flow 1. I'll then also do cash flow 2, which was going to be 2,962,188. 2,962,188. Cash flow 2. And then your cash flow 3 was going to be the net profit that included your terminal value of 40,637,794. 40,637,794. That will give you cash flow 3. And then your I, your interest was 14%. So you say 14I, and we are calculating our NPV, which is the question here. I'm getting 30,393,640,90. If you then round this figure off, it becomes 30,393,641. Can we kindly confirm this calculation? Just to see if you're following on the calculation of NPV. It was going to give you the NPV of 30,393,641. Which is the NPV for the entire company. So the value of brand FR is going to be the NPV for the entire company, NPV for the entire company minus the NPV for Z. That should give you the brand value that will give you the brand value for FR. So following through that question, you're then going to say 30 million, which is the value of the entire company, 393,641 minus the NPV for Z, which is given on the question, which is 14,503,182. That was going to give you, let's quickly do this, 393,641 minus 15,503,182. That is going to give you 14,890,459. So that is the maximum value that Z would want to pay for FR. So what we have done here, guys, we have valued, or we have calculated the value of the brand FR using the residual income. What does the residual income do? It will go and value the entire company first, and then it subtracts the value of the company that of the product that they were already having, which was Z. The difference of the two will give you the brand value for FR. So basically, that was the value of FR. And then question 5.6, which is the last one, then says, discuss why using the cost-based approach to brand valuation may not be suitable in this case. Remember, FR, it is a company that is our competitor. Trying to get the cost figures that they incurred in building that brand could be impossible. So using information that is not accurate, when you try to project cost figures, it goes without saying your figures are going to be wrong from the onset. So it was never going to be possible for one to use the cost-based approach to brand valuation. The first thing is, they are your competitors. You're never going to get that information, exactly what was incurred. If you then make assumptions, you're going to make assumptions on figures that are wrong. And in finance, you won't be in a position to get away with such. So the best method in doing this brand valuation under the current circumstance, it was going to be the residual income approach instead. You can get the selling price of the jeans. It was 500 rand, and the number of units anticipated, which were 10,000, and then you start to do the projections thereof. So basically, guys, that is your unit 5. What they want you to know: do the brand valuation using the residual income approach. Conduct a cost-benefit analysis, or you need to understand what it talks around together with the unit of measurement. And then if you look at the question 5.4 we had, can you differentiate the income approach from the residual income approach? In actual fact, we have got market approach, cost approach, and income approach. You can always go through that in your learner guide. You should know the theory behind the module. It's behind this learning unit. So that was learning unit 5. So we have done 4 and 5, which were units we never looked at when we were preparing you guys for the assignment. And then just a quick overview of the other 3. The main aspects of unit 1. You need to know what is it that we refer to as shareholders' wealth. Define it. It is the value that shareholders have. It is indicated in the market share price and also the expected receipts in dividends. The free cash flow valuation, the balance scorecard, and the customer value added. So usually the question talks around, how does marketing maximize shareholders' wealth? If you're implementing your marketing activities appropriately and correctly, it goes without saying you're going to increase sales volume. By increasing sales volume, sales revenue is going to go up. Net cash flow from operating activities will go up. Free cash flows will go up. You will then be able to maximize the share price, will then increase. By so doing, you would have maximized shareholders' wealth. The balance scorecard, we've got 4 dimensions there. The other 3, they are non-financial. Remember, we've got the financial, learning and growth, internal business processes, and the customer perception itself. All those 3 are driven by marketing. So if they are done properly and pitched at the correct level, the result is going to influence your sales revenue, which will then follow through the free cash flow valuation method. And then lastly, the customer value added, the CVA. Perceived value is what customers are willing to pay for a specific product or for a specific service. Who drives the perception that customers have? It's marketing. So during product promotion, it's marketing that will increase the perceived value. So if the perceived value has been increased, surely we can afford to increase our prices slightly, and we will still have customers buying our products. So if we have increased prices slightly, it goes without saying we're increasing our revenue or our profit margin. We should then move on to increase in sales revenue will result in increase in net cash flow from operating activities, which will result also in increase in free cash flows. The result will be an increase in market share price. If your increase in market share price has been achieved, you will be maximizing shareholders' wealth. So on unit 1, look at theory equations. Definition of shareholders' wealth. Why and how does marketing influence the shareholders' wealth maximization? Unit 2, you need to look at the gap analysis, which is the difference between the projected ideal versus what is currently on the ground, if it's projected or if it remains exactly as is. The 4 dimensions of qualitative information, just like what they did in the assignment, they can give you a case study, go and pick the value element in it. go and pick the volatility element. The simple linear regression, y is equal to a plus bx. Y, it is the dependent variable x, it is the independent variable a, your y-intercept, and your b becomes a gradient. And then you also should be able to calculate your trend analysis, calculated by saying current value subtract previous value over previous value times 100. That will be your few questions that might come on your unit 2. The rule will then go as far as what we guys did during the assignment. Remember, the assignment is open book, given 4 months before the due date. So pay attention to these main aspects: the gap analysis, the 4 dimensions, the interpretation of linear regression, and also calculating the trend analysis. And then finally, it will be your unit 3, which is price elasticity of demand. You should be able to do the calculation of price elasticity of demand, the interpretation thereof. If you have calculated your PED and you got a PED that is positive but not less than 1, it goes without saying that product is inelastic. A product with an inelastic demand, it goes without saying you will be having a more than proportionate change in prices. That is not translating to change in demand, meaning you will be having a bigger change in prices, which will translate to a smaller change in quantity demanded. So you should be able to do the calculation of your PED. And also, if you remember where I said on my few pointers, you should go through your assignment, see how they also examined you on this unit. They gave you PED, they gave you quantity of the current situation, and then the 2 price changes, the current price and the anticipated change in prices. So they were looking for the expected quantity demanded. So it's either they ask you to calculate the PED itself, or give you PED, then calculate the missing variable. Use PED to calculate at which level of demand the product will yield maximum profit, and finally to be the price discrimination degrees. First degree price discrimination, that talks around the auctioning system. The highest bidder is the one that will buy. Second degree, you'll be also looking at some form of favoritism. Somebody will be getting a discount because maybe they are regular customers. Like when you're buying items from Clicks, if you're a regular customer, by swiping your card often than not, the specific discount that they end up giving you, as opposed to somebody who just coming to buy with cash without using the card, or those that are not regular customers. And then finally will be your third degree, where you could be looking at pensioners and students, people who might not be affording or that are not earning an income. So you're looking at characteristics as such, not affording, as I've just mentioned. So basically those will be your price discrimination degrees, which is the last item I wanted to mention on unit 3. Are there any specific questions, guys, or I should be wishing you guys all the best for the forthcoming exam? Any questions? So I can see a few of your colleagues are typing. I would also emphasize the importance of you understanding the case study given, together with the grammar itself, to say which event is taking place before the other, or what event is following one that is given. Charity, usually the online will be the recording will be online, usually just after 24 hours. It could be tomorrow. I'm not sure if our administration staff are working tomorrow, but as soon as any morning Tuesday, I'm sure it will be there. You're welcome, guys. I wish you all the best, and start with questions you know, and you understand better. If I were you, I'll start with question 4, which looks very simple for me, and then I'll then move on to question 3, question 2, 1. I might end with question 5. But start with your strength. Don't just follow the structure of the paper itself. Start with questions you understand better. You're welcome, guys. I'm glad this forum was helpful to most of you. I wish you all the best. Cheers.